Have you heard of an S Corp, but aren't quite sure what all the fuss is about? Well, for some businesses, an S Corp can help you save money on your self-employed taxes. And I'm going to explain how. Hi, my name is Luke from Collective, the formation, tax and accounting solution for self-employed people. In this video, I'm going to explain what an S Corp is and how it can help you save on taxes. If you're self-employed and haven't set up a legal structure like an LLC, then you're a sole proprietorship. Sole proprietors and their businesses are considered one and the same for tax purposes. You'll report any income or losses from your business on your personal tax return. If you earn a profit, you'll add that money to any other income you've earned and pay taxes at your personal tax rate. But here's the kicker. Sole proprietors also have to pay self-employment tax on their self-employed profits. Self-employment tax is 15.3% and consists of two types of taxes, Social Security tax and Medicare tax. LLC owners also pay self-employment tax, since LLCs are automatically taxed like sole proprietors. So, you're probably wondering, how does an S Corp factor into all of this? An S Corp is a tax election. It's not a legal structure. This means that if you're a sole proprietorship, you first need to have a legal structure for your business, like an LLC, to even be taxed as an S Corp. When you are an S Corp, you maintain your legal structure, like an LLC, but you change the way your LLC is taxed. Now, here's how you save money on taxes as an S Corp. When you're taxed as an S Corp, the business profits or losses still pass through to you and your personal tax return, just like a sole proprietorship. But you don't pay self-employment taxes on the business profits. What happens instead is you'll become an employee of your S Corp, and your S Corp must pay you a reasonable compensation through payroll. So you'll receive a W-2 salary from your business. Your S Corp salary is subject to payroll taxes, which are at 15.3%, and pay into your Social Security and Medicare, just like the self-employment tax. Your business pays for half of those taxes, and you pay for the other half. So, where do the savings happen? Well, as an S Corp owner, you're not required to pay yourself all of your business profits as a salary, just what's considered reasonable for your work. This means that less money is subject to those Social Security and Medicare taxes. Let's take a look at how this works. This example uses $160,000 in self-employed profits and shows the difference if you were taxed as a sole proprietorship versus an S Corp. You can see that with less money subject to that 15.3% tax, you'll pay less tax overall. Keep in mind that this is an estimate and a simplified calculation, but you get the point. Let's do a recap. A few things you'll need to remember about an S Corp are: 1, it's a tax election. It's not a legal structure. You'll have to form a legal structure first, like an LLC, before you can even ask the IRS to tax your business as an S Corp. And 2, as an S Corp owner, you must pay yourself a reasonable compensation for your work via payroll. You can't not pay yourself as a way to avoid Social Security and Medicare taxes. I so hope this video helped you understand how being taxed as an S Corp could help you save some serious money on your taxes. If you need more help setting up your LLC and your S Corp, go to collective.com and learn how we can help you with your business formation, taxes, accounting, and bookkeeping. And if you enjoyed this video, please like, comment, and subscribe below, and be sure to check out the additional resources linked in the description. Thank you guys so much for watching.